The markets, August 2020, let's go ahead and move forward. So when you're looking at the overall sectors out there, the U.S. sectors really are moving pretty strongly right now. When you look at the left side of this screen, you've got a pie chart there, and it's showing you that many things are starting to return to some kind of normalcy. Especially in the service, the travel, shopping, restaurants, things like that. And you can see that the core equities, the new buys by sector, are really ramping up there as the pie chart shows. And you can see that the financials are really driving it right now. If you look at the right side of the screen, you see the average 2020 EPS change by sector. So when we think about the money managers and where they want to go to invest, this is the type of information that they're looking at. So if you look at the far right side of the chart where the S&P 500 is, you can see that we're targeting an average of 12% there. But then when you look at consumer discretion, financials, information technology, industrials, and healthcare, you can see that they're moving substantially higher. And this is what we're talking about with the money managers looking at this data, making some adjustments, and continue this ball rolling down the stream here to make sure that we get the returns and kind of capitalize on what's going on in the markets out there today. So that's a very positive thing right there. Moving forward, you've all seen this chart. Matter of fact, many of you have seen it a lot back in 2020 because we were talking about the S&P 500, the PE ratios, or forward price earnings ratio. When you look at this chart, the red is overvalued, the yellow is fairly priced, blue is attractive, and green is very attractive. And I'm gonna point you to 2020 and 2021, so the far right side of this screen, where you can see in 2020 the PE ratio was really kind of starting to get up there. We were in the mid-range of that overvalue. But what we know now and what's happening with a lot of these companies, the profitability is growing, which is lowering the PE ratio. So that's why when we're looking at moving forward here, you've got two aspects of it. One is the PE ratio going down because earnings are so good. And the other aspect of it is we do still have parts of the economy, sectors that haven't really kicked off yet, which we believe as things go to normalization, we will see those areas get an uptick as well. So we're not worried about things being overvalued right now. The signs aren't saying that we've got an issue. So it's full on with equities at this point and risk moving forward. Let's talk about emerging markets, Asia a little bit here. They remain relatively strong when you're looking at it. So let me explain this chart a little bit for you. On the chart as a whole, when you're looking at the numbers on each one of the bars, the lower the number, the better. And what we're referring to is the global equity markets summary store analysis. And this is something that City National Rockdale puts together to kind of give an understanding of where are the opportunities. So on this chart, you've got on the left axis here, 0 to 250. And then on the horizontal axis, you've got the different market areas. And what we're seeing is in the US and in the emerging markets, Asia, there is still a lot of opportunity there. So you'll see the US still be overweighted in a lot of the portfolios, but you will start seeing a little bit more peppering in of the emerging markets, Asia. Let's look a little bit further when you're talking about stocks versus investment grade bonds. I think this, Rocky, is a theme that you're probably, I know clients are seeing this in almost every one of the presentations we have, and it's going to continue on for a long period of time because, again, we are in a secular bear market for bonds. So in this chart, what it's showing is the relationship between the S&P 500's earning yield versus the 10-year Treasury yield. And we're seeing a big dichotomy today as opposed to where we were, back in the 90s and up until 2000 when there seemed to be a little bit of a disconnect between the two lines. Prior to 2000, it was almost lockstep between the equities and the 10-year Treasury yield. But now we're seeing a great dichotomy between these two, and it's spreading even further as far as the separation. And this is where the equities is really where we need to be focusing. The bond or investment grade bonds are going to be volatile. We know that. But if they're volatile with no return, that just doesn't make a whole lot of sense. So if you're going to take the risk, let's take the risk where we're going to get the highest rate of return. And that, again, is equities. Let's talk a little bit about high yield munis. So munis, we're talking about the high yield muni tax equivalent rolling 3-year monthly average, which is in the black, and then the 10-year UST 3-month rolling yield, which is in the blue. Now, again, anytime you're talking about higher yield, you're talking about a little bit more risk, more volatility, and you can kind of see that on this chart here. But you can also see that the munis are really outperforming the treasuries by about threefold, actually more than threefold. So if we do have to go into something that's a little bit more conservative, the munis would be a likely candidate as opposed to going to high quality bonds, because you are going to get a better return. And in many cases, you're going to get a better net tax return as well. And it is something that we are looking at very seriously going into what looks to be a very high rising tax environment coming down the road here. Let's look at the opportunistic income performance. So on this chart, we're showing again on the left side, the axis shows the rates of return 0 to 7%. And then we've got the different type bonds. So you got investment grade corporates, you've got high yield bonds, you've got the senior secured loans, you've got the CLO debt, and emerging markets high yield bonds. If you're looking at it from a return standpoint, the black is 12/31/2019, and the blue bars, which virtually all of them are lower, is as of 7/31/21. And you can see where is the highest potential for return. Well, emerging markets high yield bond. Again, we're focusing on where the returns are, and that is where the money managers are looking as well. So as we reallocate the overall portfolio for our clients, the money managers are virtually doing the same thing. You're going to see some rotations going on moving forward. This just really gives you a bigger picture of the global markets. You can see the overweighted and underweighted markets out there. And some of the underweighted, like the investment grade bonds, are done on purpose because, again, the returns just aren't there. So why would we go in an area that just doesn't give the returns? Even the developed international stocks, again, underweighted in a lot of the portfolios. And we're seeing the US large cap, mid and small cap is where a lot of the returns are coming from. And again, I kind of probably sound like a broken record here, Rock, but emerging markets will be an area we'll be going to. If you look at the expected inflation, that's the gold dotted line there. And that is sitting at about 2%. And Rocky painted the picture out there. We've got short-term demand, which is causing inflation in specific areas, but you've got other areas that are just more status quo from an inflation standpoint. And as the supply chain normalizes, you'll see all that kind of get back in line with the rest of the 2%. The markets are going pretty strong. Yeah. You know, I've said it before in a lot of the meetings with our clients. You know, you look at where the GDP is, you know, what are they projecting? And for the end of this year, I think we're looking at between 4.5 or 5.5 to 7.5% now is what the readjusted numbers are. So not likely we're going to have a recession when you've got GDP numbers like that. Right. And same thing looking forward into next year. They're looking very, very promising. So unless we get some kind of black swan event, and in case you're not aware of what a black swan event is, you don't know when it's coming, you don't know what it's about, you don't know how it's going to affect you. So you can't plan for those things. You can have strategies to implement if they happen, right, based on experience, but you don't know when they're going to happen. So right now it's risk on, and let's keep moving forward and capture the gains out of the market. Right.
And that's another reason to be tactically managed.
Oh my goodness, yeah.
You look at COVID. COVID was a black swan. Nobody saw that coming.
Yeah.
And there were winners and losers. We know about that. We've talked about it. You know, how the airline industry took a huge hit. Anything that got shut down, well, at the other time, companies like Google and Amazon were flourishing. UPS, FedEx, those companies were big winners, but a lot of losers out there. And if you're not tactically managed, you're not being adjusted,
right,
to make that portfolio maintain its return. So we believe in it. It's going to continue to play out that way while we've got these supply chain disruptions, while we've got things going on around the world. You need to be able to be nimble enough to make adjustments as things change in the world.
Yeah, and that's not to say we've left the structured portfolios behind, because we haven't, because there's still some stability
there. It's a foundation piece, but
right,
where you get that extra percent or two return annually comes with tactically managing and overweighting and underweighting.
Absolutely.
In areas that can give you that boost.
Yeah, I agree with you. So where do we go from here then?
I think let's do a little recap.
All right, that sounds good.
And what we're looking at moving forward.
And here we go.